For most of this year, the story was simple. Japan's money was dying. Japan spent $73.6 billion trying to save the yen. It bought 3 weeks. Then the yen fell again.
And last week, something extremely rare happened. America stepped in to help rescue Japan's currency. That should make you stop. Why does Washington care what happens to the yen?
Because for 30 years, Japan operated like the world's cheapest bank. Hedge funds borrowed yen for almost nothing and used that money to buy American bonds, stocks, and leveraged investments across the world. But now that system is beginning to turn. Japanese bonds finally pay real interest. The yen is being pushed higher, and money that spent a generation leaving Japan finally has a reason to come home.
If it returns slowly, almost nobody notices. If it returns quickly, traders may be forced to sell whatever they own just to buy back the yen they borrowed. That means the dangerous part of this story is not simply that the yen became weak. It is what happens when the yen suddenly becomes strong. And while a million people blamed a secret Japanese law from 1896, the real mechanism was sitting in plain sight with a percentage sign beside it. This is how Japan became the world's cheapest source of money, why that system is changing, and what could happen when the money turns around. After Japan's economic bubble collapsed in the early 1990s, prices, wages, and growth barely moved for 3 decades. To keep the economy alive, the Bank of Japan pushed interest rates towards zero and left them there for a generation. Money in Japan became almost free to borrow, and Wall Street noticed. Borrow yen for almost nothing, convert it into dollars, buy treasury bonds, corporate debt, stocks, or something much riskier, then keep the difference in returns. That is the yen carry trade. Not magic, just a gap between 2 interest rates, repeated by investors around the world. And every version of it begins by selling yen. Japan imports most of its energy. Oil is priced in dollars, so when the yen falls, every barrel becomes more expensive. Companies need more dollars to buy the same fuel, putting even more pressure on the yen. The weak currency makes energy expensive. That inflation makes it harder for the Bank of Japan to keep money cheap. That is the trap. Cheap money protected Japan's enormous government debt and weakened the yen. Raising rates could support the yen, but it also makes that debt more expensive to carry. Japan's gross government debt is roughly 204% of its economy. It survived partly because almost 0% of an enormous number can still be manageable, but almost zero is disappearing. In June, the Bank of Japan raised its policy rate to 1%. That sounds tiny until you realize it is the highest Japanese rate since 1995. Now the price of that money is moving. Before raising rates too far, Japan tried the faster option. It bought its own currency. Between late April and late May, the government spent 11.7 trillion yen, about $73.6 billion, intervening in the market. For a while, it worked. The yen strengthened. Traders backed away. Tokyo looked like it had drawn a line. Then the market crossed it again. By July, $1 bought more than 163 yen. The intervention had purchased time, not changed the reason investors preferred dollars. Then Japan intervened again, this time with help from the United States. The yen jumped from above 163 to the mid-150s before settling near 157 on August 3rd. That move matters, but it is still an intervention. Governments can force a market to move. Keeping it there requires the economics underneath the market to agree. And right as the yen was reaching its weakest point, the internet decided it had discovered Japan's real plan. An anonymous account claiming to work inside the Bank of Japan posted a vague warning about Article 589. Foreign borrowers, it said, should not assume Japanese funding would always be available. Crypto accounts turned that into Tokyo's financial doomsday button, a hidden clause from 1896 that could call its money home and detonate the carry trade. More than 1 million people saw the post. There was only one problem. Japan publishes the law online, in English, for free. Article 589 says that a lender cannot demand interest unless the 2 sides agreed to interest. That is it. It is private contract law. It does not control bank lending, loan rollovers, or capital flows. The Bank of Japan cannot activate it because there is nothing to activate. There was even a community note under the original post explaining the mistake. The warning got more than 1 million views anyway. The law was fake as an explanation, but the fear underneath it was not. Japan is the largest foreign holder of United States government debt. The carry trade is crowded, and Japanese money has a new reason to stay home. The internet invented a secret button because the real answer looked too boring. The real answer was a bond paying 4%. For decades, Japanese savers faced a strange punishment.
Keep your money at home and earn almost nothing. Send it overseas and get paid. That rational choice is changing. Japan's 10-year government bond yield reached 2.9%, its highest level since 1996. 30-year bonds moved to around 4%. 4% may not sound revolutionary, but for a Japanese insurer that spent 30 years searching abroad for yield, it changes the map. A domestic bond now offers a meaningful return in yen, without foreign exchange risk. For years, the Bank of Japan bought so many government bonds that it owned more than half of the outstanding market. Its share has now fallen below half, and it plans to keep reducing its holdings through 2030. The market now has to discover the price that brings private buyers back, and they are coming. In July, Finance Minister Satsuki Katayama said she wanted pension funds to invest more in Japanese assets. Markets reacted as if she had issued an order. She had not. The giant public pension fund reports to a different ministry, and Reuters found no immediate allocation change. But private institutions did not need an order. Meiji Yasuda Life doubled its planned purchases of Japanese government bonds to more than 2 trillion yen. Its description of 4% 30-year bonds was almost cheerful. A perfect buying opportunity. Japanese insurers bought more super long government bonds in June than in any month in 3 years. Half of the country's major life insurers plan to increase domestic bond holdings. This is the part the viral post almost understood. Nobody called the money home. Home started paying better, and a price can move far more money than an order ever could. Now we get to the reason the United States cares about the yen. Japanese investors hold roughly $1.2 trillion in United States treasuries. That makes Japan the largest foreign holder of American government debt, with about $1.08 of the federal debt held abroad. This does not mean Japan is dumping treasuries. There is no evidence of a fire sale. The real risk is quieter. It is not what Japan sells tomorrow. It is what Japanese investors choose to buy next year. If a Japanese insurer can earn around 4% at home without foreign exchange risk, buying an overseas bond becomes less automatic. And bond markets are priced at the margin. The United States does not need every Japanese investor to leave. A major buyer becoming less eager can mean offering a slightly higher yield to attract somebody else. The American 10-year Treasury is also an important benchmark for 30-year mortgage rates. The two do not move perfectly together. But when Treasury yields rise, borrowing costs can follow. That is the honest version of how a decision inside a Japanese insurance company can eventually reach a house in Ohio, Texas, or California. Not through a secret law, through an auction. The slower movement of Japanese savings is one story. The faster story is the money that was borrowed. Remember the carry trade. The investor borrows yen and buys something that pays more. But the loan still has to be repaid in yen. If the yen suddenly strengthens, repayment becomes more expensive. The investor may have to sell stocks, bonds, crypto, or whatever else they own to buy back yen and close the loan. That buying pushes the yen higher, squeezing the next investor, who also has to sell something and buy yen. The exit door does not get smaller, the crowd gets larger. We saw a version of this stress in August 2024. A Bank of Japan rate increase collided with weak American jobs data and crowded market positioning. The Nikkei fell 12.4% in one day, its worst day since 1987. The S&P fell about 3%. The Japanese rate increase did not cause the crash by itself. It was one match landing near a lot of dry grass. Go back to 1998, and the pattern is even clearer. During the long-term capital management unwind, the dollar moved 7% against the yen in a single day, and more than 15% over 8 weeks. The stronger yen did not create the leverage, it exposed it. And today, the one piece of positioning we can actually see is crowded again. As of July 24th, speculators were net short roughly 152,000 yen contracts. That is not the whole carry trade. Most currency exposure sits in private agreements the public cannot see. So when somebody gives you a clean $1 trillion estimate, they are guessing. We know the trade is crowded. We do not know exactly how crowded. And that uncertainty is the point. 2 clocks are now running in Japan. On the slow clock, the Bank of Japan reduces its bond holdings. Insurers reconsider where they invest. More money stays home because home finally pays. On the fast clock, the yen jumps. Leveraged traders rush for the same exit, and assets far outside Japan get sold to repay loans most people never knew existed. If the first clock wins, Japan gets a difficult return to normal. If the second one wins, the world's cheapest bank starts collecting its loans all at once. The viral warning was wrong. There is no secret law, no doomsday button, no order calling the money home. There is only a price. The yen became weak because the price of money rewarded leaving Japan. It becomes dangerous when that price starts bringing the money back.
Millions of rational decisions built this system. Now those decisions are beginning to change direction. Together,